My name is Al Salus. I lead Investream. We're an investment firm here in Houston. So on today's topic, we're going to talk about the outlook and the risks. We're going to share with you our curated list of resources that we love to watch that is a little more grounded and research based. And we'll give you our take at the end of this. So it's going to be a lot of economics, a lot of charts. Apologize in advance. It's going to be a meaty webinar. Just to talk about the disclaimer, we are doing this for educational purposes only. Please do not make any investment decisions and consult with your legal or financial advisors when you want to do so. I'm not your CPA, I'm not your attorney, and I'm not your economics too. Like I said, we're going to start with the resources first. A macro view at the economy level, job market, inflation, what's going to happen in the fiscal policy. Then we zoom in into our markets in Oklahoma and Texas. Some projection on what is that going to do to the interest rate, recession, what's the impact on real estate? Why does it matter? What are the other news, and are they going to really impact commercial real estate in general or Investream approach? So we'll get started. The first thing I want to check with everyone is like, where do you get your news from? Where do you get your information from? And over the years, we've kind of looked at so many, and we process so much data to come up with a little bit of a more curated set of data sources for us. We like to be data driven. There's a lot of noise. There's a lot of noise in the news. There's a lot of hype by biased people in every industry. So we always want to make sure that we get the data from the sources, listen to other active veterans, and I put active between quotations because they need to be active. They need to be in the market. Otherwise, they don't know what they're talking about. But I always look at every year from economy to jobs to income. Then we go into commercial real estate. And then I look at the sort of what's happening outside of our industry that may or may not impact um, our industry, our decisions to make investments, where to buy, where to guide our investors into the markets, the asset classes, etc. So this is some that we really liked over the years, and a lot of their predictions are solid. So we kind of track. This is what they predicted, and this is where we ended up, just to kind of make it real. ITR Economics is really powerful. They have all access to all data, and they always show a global and local perspective. Obviously, the Bureau of Labor Statistics, Marcus and Millichap, CBRE, BizNow, and CoStar for real estate data. We look at the Big Four and the World Economic Forum for the bigger picture. And then CCIM throws a lot of data and courses throughout the year. So a mix of local, a mix of economy, commercial real estate, veterans and industry. And so we don't get distracted by everything that kind of get thrown at our investors. And we like to do this for ourselves first and then share it with our investors as well. So everybody's more informed into how we get into this next year. So we'll start with the market report. As you may have heard in the news, we actually had a very strong Q2 and Q3 when it comes to GDP. So the economy is growing. We had a dip, and we're looking at the orange line here representing the GDP. And so Q1 was below, so there was a shrinking phenomena really quickly. And then we went to Q2 and Q3, and we expect Q4 to come out very strong. Now, GDP on its own doesn't paint any picture really, because if we dig deeper into why is the economy growing, it's two factors. One is AI. Everybody's going and investing in AI and in data centers. And so there's a lot of money in the market, and that's driving GDP to grow, whether it's building data centers or doing AI programming and anything in between. The second economic driver, which can be misleading too, is the higher income families are spending money, but the rest of Americans are not. And so if you exclude the AI and the data center and the upper higher income spending, the economy is actually shrinking. So it's a little bit misleading. Yes, the economy is growing, all bets on AI, higher income paying more and buying more. So spending is there, but it's not distributed. And combined with less and less job creations in the market. So it's kind of like an interesting GDP is great, but don't just look at GDP. When it comes to next year, they think that GDP is going to be slower. Maybe AI craze will slow down, and the rest of the economy is potentially shrinking. So 30,000 feet, the economy is shrinking. We're not growing as we should be. When it comes to inflation, I think inflation is sticky. So if you look at these lines here, yes, the crazy 2021, 2022 COVID days, then the tail end of that is a blue line where housing picked up, and now things are dropping. So housing is already correcting. There's not a lot of houses sales activities, but the prices of homes generally are going down, even in hot markets. The rest, you look at these lines, we're kind of like flat from 24 to 25, a little bit down here, a little bit up here. And they call that sticky inflation. So inflation is here, it's not moving anywhere. And with more tariffs not being settled yet, we think that inflation might pick up again slightly. The only good news on the prices is the gas price. So gas price is going down, and that will help a lot because gas goes into so many other consumables. But overall, inflation is pretty much flat now, and it's sticking. It's not going down further. They don't see it going down until 27, 28, and they predict that 26 is going to be slightly worse actually than 25. So GDP, economy, then inflation, and then jobs. That's the other factor we look at in any economy. So if you look at the chart, it's trending down. So this year is worse than last year. Not by a lot. We went up to 4.4%. The gains was 2 million last year. This year was 500,000. So much lower than last year. But if you look at the last 6 months, it's kind of concerning. We're getting into the negative now more and more. And if this trends continue without fiscal policy adjustment, then we're actually going to lose more jobs and we're going to have more unemployment. So typically the Fed look at inflation and they look at job market and they try to balance the two to make sure that we're not shrinking too much. We're hiring, but also we don't have inflation because once they put money in the economy, then inflation comes back again. So that's the juggling act that they work on. ITR, I want to say they're normally grounded. They're not optimistic. They're not conservative. They tell you what it is. And I would say they're close to reality normally. And one of the things that kind of caught our attention when Sammy and I were doing the research, they're predicting Great Depression, which is crazy. I think we're going to go into recession, not depression, but we'll talk about that a little more. So just be ready. Don't be alarmed. Just be ready. I don't think that's very shocking. They talk about like you can't change the wind, you can adjust your sails. So what tactics are you going to use in such environment? And they shared a couple of good news around where the money is flowing. We already talked about AI, but there's a lot of good old industries that needs a lot of investment and will have a lot of investments, whether it's the medical field, the pharma side, AI, we already know, but they're moving into physical AI, which is interesting. Electrification, the electric grid needs to be improved. A lot of nuclear plants are planned now. A lot of in the infrastructure investments are happening to improve our electric grid. and mainly driven by the data centers. Data centers is driving electric bills extremely high. And that's something that they need to control. It's like it used to be gas drives everything up. Now it's the electric bill because data center is sucking that capacity. So there's a lot of investment into the infrastructure in general and cybersecurity as well. So not every sector will be bad economy-wise. These are areas where they think there's going to be a lot of investments and growth, but it doesn't look great. It's not going to look great in 2026. Here's another chart based on Moody's AI model predicting a recession. This is a summary from Marcus and Millichap. And you can see here, some of this was probability versus the threshold. And as they were predicting that AI was predicting the recession model. Here's your 07, 08. Here's your COVID. And this is where we're at now. It's a very gloomy picture when it comes to recession. So what does that mean? Fiscal policy, like I said, they look at inflation, they look at job market, they look at GDP, and then they will decide, should we stimulate the economy, i.e. inject money in the economy, i.e. lower the interest rate, or is that going to make inflation worse? And based on everything that I showed you, the Congressional Budget Office expect rates to be cut more. The Fed indicated there will be more cuts. I think they're a little slow, and the government shutdown did not help because we didn't have data during the government shutdown. So some of these reports are coming late. But overall, I see that the rates are going to go down further, which is interesting because typically when rates go down, mortgages go down. And I think we just had a record low mortgages. I think we're started to get into the high 5% territory finally. But for commercial real estate, most of the debt and the loans are tied to the 10-year treasury. And as you can imagine, people are buying gold and buying silver and moving away from US bonds. So even though interest rate might drop at the Fed level, we may actually see a slight increase on the commercial real estate mortgages. But for the most part, mortgages are probably going to stay flat, and we kind of understand the situation we're in right now. So maybe it's going to provide some easement for home buyers on the interest rate, but not for commercial real estate. A little more about the news and what's in the news and what's real and what's noise. We like to always look at Marcus Millichap risk graph. This is from last year because they haven't shared or released their chart this year. But just to track how good they were last year, they talked about global supply chain disruptions. We kind of are aware of that. Deportation is happening. Federal Reserve misstep. I think they were referring to maybe moving too slow, and I think that's kind of true. They're moving too slow, and I think that's, bond market sell-off. That's what's driving the interest rate on commercial real estate to be high because people are selling their bonds and flocking to commodities right now. Things that I'm looking at in the news and how it impacts commercial real estate, which we'll discuss deeper in a bit, but tariffs definitely, impacts our materials. We have one project in Oklahoma City where we ended up buying the steel building before we even, as we were closing on the land because we wanted to lock in the low price. And so tariffs is real, and tariffs isn't done yet, although it's coming to an end, at least as a negotiating tactic by the administration. But we still have some tariff wars, and that is providing some uncertainty on material costs, construction costs, etc. ICE activity impact on labor. We started to see it on the lower end projects where we're working with small to medium general contractors. They're losing some of their subcontractors due to immigration or fear of immigration. So a lot of these days, people not show up on site. We don't see that with bigger GCs, general contractors, but we see them definitely on our smaller projects. Executive orders, that's some good news there because we've seen the administration trying to fight back some of the very institutional practices that led to more and more housing prices, higher housing prices. Not sure if that's going to be written into law and executed further, but for now, they did say the likes of Blackstone are not allowed to buy single family residences and that should hopefully slow down the housing crisis. America First initiatives, some of them are we expect to happen, some of them we wish they happen because something's got to give and they need to do something. In Texas, for example, they reduced the property taxes after 3 years of record high property taxes, but it's not enough. So interest rates, there's a lot of pressure on the Fed to reduce interest. Are we going to see subsidized housing to stimulate things? We have one property where we secured a HUD loan and it was a nice loan. The only problem is there's less government employees to work with, so closing took forever. But is there going to be any stimulation to housing like it happened in 2008, where they sent direct money to the home buyers, and then the $2,000 check? So because tariff is not done, labor is a little bit limited and inflation isn't going anywhere. We're hoping and expecting some America First initiatives that will help ease the commercial real estate and because housing is something that they always talk about. America First is happening. The US just withdrew from a lot of United Nation. It's just a symbolic move, but we can see that that will impact tourism. So tourism, Airbnb, airlines, hotels are not going to do great next year. There's less tourism, internal and external tourism. But we see lower gas prices. That's good. Are they going to have subsidies? We started to see the Blackstone initiative or executive order. So I think America First eventually will help commercial real estate, but maybe in a more of a government stepping in versus natural dynamics of the market. I won't spend too much time on the World Economic Forum, but just wanted to show you a glimpse of what's happening on a global level. They do show a 2 year versus 10-year global outlook and the likelihood of having issues. And you can see the majority is orange, light orange and dark orange, which is about 82% seeing it's going to be unsettled or turbulent globally. Yeah. What's interesting is it used to be a lot of social polarization and democracy issues and misinformation and disinformation, but this year it has changed, and it's more focused on economy. So everything is economy driven. The conflicts, the tariffs, the actual wars. It's interesting to see that the majority of their 2 year prediction is now shifted to economical categories as opposed to weather-related, global warming, and democracy issues, which that tells you that economy issues are real. And whenever you tell someone, "Here's your pocket and here's your democracy," people talk about pockets first. Here's an explanation. What I just talked to you about is what's going to happen long term and short term. All right. Why does this all matter? Because we look at that, be like, okay, so what? So this is what happens when all of these happens for real estate, for the sake of commercial real estate. Cushman and Wakefield already shared their 2026 outlook, and there's interesting finding that we see as consistent, nothing surprising, but kind of cement our approach as Investream with our investors. So Industrial vacant spaces, they're talking about big box industrial. They built them everywhere. Everything was industrial in the last few years. And so there's a lot of vacant big spaces that will help with the pricing. Offices depends on the office, but typically if it's in downtown business district or near downtown, it's ghost town. Offices are empty, nobody's moving in. Everybody's moving out. There's a lot more satellite offices, there are a lot more suburban offices happening. But general big industrial and big office, there's more supply than demand. The nice thing about office pipeline is that all-time low. So if you pick the right suburbs, you will have strong absorption. Everybody, like, don't treat office as one thing, is what they're saying. Big office is different than suburban office. Same thing on industrial. Absorption is high. We just built too many. So eventually it will catch up. And there's a lot of conversion now. It's like an old Macy's becomes a data center, or, there's a lot of conversions happening to these empty buildings, but absorption is here, especially for industrial and data center. So I'll think about suburban office is good. Industrial is being absorbed, but we built too many. When it comes to multifamily and apartment complexes, low inventory, no one built apartments in the last 2 years. There was a lot of inventory that came from the COVID sort of craze, and with high mortgage rates, everybody kind of paused on multifamily new construction, and so it's an absorption game right now. There's tons of need. We're becoming a renters nation, and people wanted to move to apartments. And so that's keeping multifamily alive, but generally speaking, no new supply. When it comes to housing, same thing. A lot of home builders are slowing down on building new homes because they sit on the market and they started to see actual price correction faster than used homes. So if you want to buy a house, this is the time to go negotiate with a new home builder. The reason we didn't see the correction in used housing market because everybody is holding to their beautiful mortgage more than the house itself. Anyone who refinance into 2 to 3% in the good days, they don't want to sell because if they sell, they're gonna get stuck with a new house, new mortgage, much higher interest. So basically, activity on used housing market is very minimal. No one's buying, no one's selling. But the only activity on the house rental on the residential side is new houses that are on the market. Retail is going back to a steady state because at one point retail was everywhere and there was more inventory than we needed. But now we're into maybe retail equilibrium. Supply and demand is getting closer. And the main thing that we really took away from this report is the big story is the alternatives, the niche of every asset class. So instead of multifamily, it's houses that are built for rent or senior housing. Instead of general office, we're doing medical office. Instead of student housing. So with the exception of data center, which is hot, we don't participate in data center, but everything else that we participate is they did focus a lot on that. And what's nice about these is it's kind of satisfied the three rules that we look at for any deal. Demand is high, supply is low, and tenants pay premium for one reason or another. A little more trends. We focus on our markets and make it local. Everything in real estate is local. So yes, we look at the big picture, but we narrow it down to where we want to be. One of the top markets we like to be in is Dallas and Houston. And Dallas Fort Worth is number one. Houston stepped down from 3 to number 5, but it's close. Anything from 2 to 5, I think they're all close. So we can still see that Houston and Dallas are probably one of the best two cities in the nation, and we're doubling down on that. Why Dallas? 100 new corporate headquarters moved in the last 6, 7 years. It's insane. The number one migration of headquarters, and I think second by North Carolina or something like that. Financial market is huge, and all kinds of commercial real estate is happening, and especially in the north side of Dallas. Um, Mixed-use districts, office to residential. There's a lot of industrial happening in Fort Worth as well, and south of Dallas. So all overall, Dallas is a real economy. It's way different than the rest of the national economy. So anything in Texas Triangle is great, but Dallas is definitely is the lead. Houston, solid. About 700 billion is the Houston economy. It's crazy. We continue to see new jobs added, more diversified in healthcare, health sciences, construction. There's a lot of infrastructure projects happening around the port and the expansion of the city. So Houston is real economy as well. Not all energy and oil and gas anymore, but that still plays a big role. Um, Jobs are slowing down slightly in Houston, but it doesn't compare anything like what's happening nationwide. And industrial is just growing with the port expansion. Industrial becomes more and more relevant. There's a lot happening on the Highway Texas 99 when it comes to industrial, and we like that position in Houston. Oklahoma City is slow and steady. That's what Oklahoma City is. Continues to grow, no big swings. Unemployment is getting worse slightly, nothing huge. Energy is a big sector, but retail is seeing a boost. It's almost like anybody who's fleeing Dallas going to Oklahoma City right now. And that has an impact. They're more diversified logistics hub, and not reliant only on energy and oil and gas. And some reports show that Oklahoma is one of the best cities to live as a small, big city and as a retirement town, given its demographics and crime rate being low. So Oklahoma City is not for every project. We focus on Oklahoma City when it comes to industrial and senior housing specifically. A little bit more data from PwC. As I mentioned, financial issues and challenges are going to continue to happen with slower job market, slower job income growth, and potentially inflation. Who see, what's happening to them. I actually loved this when I saw it the first time. I was like, oh, this is exactly what I talk about to the team. Niche is now essential. Senior housing is needed. More medical offices are needed and data centers are needed. So if you think about industrial, niche medical, and niche offices and niche multifamily into senior housing, that's no longer a one-off or a side project that you see in certain cities. That's a new trend. And PwC always talks about, what should you focus on, and you see us in you see that repeated in our summary too. Short list of resilient geographies. Be extremely focused on which zip codes and what trends. So you can't be the good old real estate apartments or the good old real estate retail. You have to be very specific in what area and what niche are you serving. Bringing it back to real estate, this is what we do. But before I jump into that, I'll talk about the cycle clock. I always ask my team, where do you think we are in? Are we in the fall? Are we into winter? Have we passed the winter? Are we getting close to the winter time? This is where money is hard and corrections start to happen. And you start seeing the interest rate go down. So the emotional cycle of that is whenever it's getting transitioning from fall to winter, you'll see different kind of behaviors by investors. are, some will be panicking, some will be in desperation and doing things that they shouldn't do. Um, they're going to become more cynical and more negative and sometimes immobile, meaning they're not going to make investment decisions, which is not typically a good idea. So sometimes it's good to not invest more in a certain market, but doing nothing can hurt you if you don't reallocate your wealth generally. My prediction is we're getting into between 5 and 6 right now. We're getting out of the fall season, and there is a correction in the market happening soon. And so what's nice about that is this is where you start talking about, okay, if the winter is here, people are sitting on the sideline. Who's going to pick up those properties and continue to be relevant in the market versus people are just going to not do anything until the market corrects itself. And so I consider Investream, we're in like, okay, we're starting to get into the home segment. And we did the same thing last year. Everybody was sitting on the sideline and we doubled down on the niche development. It's the busiest year for us to date. And I think 2026 will be the same. Selective buying for discounted properties, continue to do niche development is the way to go. So here's my main takeaways from all of that. And I hope I didn't lose you in the process. Tariffs, we believe tariff resolutions are going to happen soon, meaning the last bit of negotiation between the big powers of supply chain for the US is going to come to an end. There will be a China divorce, whether we like it or not. May not be a bad thing. We already see gas prices going down, whether it's because of Venezuela or not. Venezuela is going to take some time, but gas prices at the pump next to my house is already $1.98. That's great news on the gas side, but it's not great news when it comes to economy. Every time I see gas prices go down, I'm like, great, I don't know. But some manufacturing is coming back to the US. So as we continue to disconnect more and more from China, you're going to see more manufacturing in the US and around the US and the Western Hemisphere. And that might actually increase inflation slightly short term before it kind of corrects itself. So it's mixed messaging. Some policies are easing inflation, some policies are going to bring inflation back. And I think that's what ITR predicted. Overall inflation might come back slightly this year. Job market will continue to suffer. So if we don't see rate cuts, we're going to see less investment from the corporations, which means less hiring and potentially layoffs. So if the Fed doesn't move fast enough, we're going to see a recession, hopefully not a depression. I say it's imminent, and I hope it doesn't happen and we land the plane. But my motto is plan for the worst, hope for the best. Like we can't really ignore what's happening around us. It impacts our renters, it impacts our investors, all of that behavior that's happening when people lose their job and they want to have a roof over their head, or a business suffering because their revenue is down and they can't renew the lease, or etc. There's so many things that are not great around the recession. So we hope interest rate drops will compensate for that, and hopefully inflation doesn't get too sticky. We do think that the commercial real estate and residential will correct itself. It's already correcting. In the second half of 2025, we saw good correction, sometimes 8 to 10% on the houses prices. And in the commercial real estate, we've seen 20, 25, 30% discount. One of the deals we bought in Oklahoma, we bought at like 35% discounted. It was a great buy because it gives our investors a day one built-in equity, basically. And so we normally buy things for 5 years. So even if a recession happens, we can hold it for longer and see it on the other end. Single family is interesting. I would argue that we're becoming a renter's nation, and build to rent communities is going to solve some of that for people who can't afford to buy a house in a good school district. They may still rent a house as opposed to renting an apartment. But if there's any subsidies by the government to the single family homeowners, especially first time homeowners, I think single family will come back. So that's a big if. If they don't inject any subsidies or any relief, I don't think single family will come back anytime soon. Senior housing is solid. We're an aging nation as well. There's 10,000 baby boomers retiring every day, and Gen X is following that trend. So we like that. And we're actually focusing on 55 plus, which is our young adults or young seniors, where we create lifestyle, we create amenities, and we give them good reasons to rent and enjoy their community. Same thing to build to rent. Instead of having that, hotel-looking apartment, we're trying to create solutions and products for our tenants to have a nice home experience, even if they can't afford to buy in that area. And then medical will always be great. Medicine is growing. All the medical companies, systems, health sciences, pharma. So anything around medical will continue to play well. And they are premium tenants. Typically, they pay premium and they stay long. So we like that. And then if we want to bet on anything for 2026 is doubling down on logistics, light warehouse, last mile delivery, in neighborhoods, small warehouse, and on the highways. But we continue to focus on premium tenants. We don't want to deal with maybe startups, but we want to deal with credit tenants that have strong credit and they can survive a recession. And then anyone who asks me for financial advice, I always say I'm not your CPA, I'm not your lawyer, I'm not your financial advisor. But if you haven't bought gold, please buy silver. If you haven't bought gold and silver and you feel it's already too high, then buy Texas land. That's my third category. Sorry, Oklahoma. So certain states and cities where migration is happening, job growth is happening, land is still king. And we're not seeing discounts on land as well. So it holds its value. It's a commodity in a way. And that will allow us to continue to produce products, new products, niche products that are not available in the market, like the senior housing and the build to rent. I'll finalize with Investream take. I probably alluded to many of these, but more than ever, you want to work with people who are extremely selective, and that's what I tell my team every day. We need to choose our property sectors and market very wisely. We look at 100 to 150 deals a year to pick 3 or 4. So we're very selective, and that's what we were going to double down on. When I say property sector, I'm not talking multifamily. I'm talking sub-asset class. I'm talking senior housing within residential. And instead of talking about Houston, we actually look at certain zip codes that we want to be in. Northwest quadrant and north of Houston, northeast of Dallas, northwest of Oklahoma. So we're very specific even within the markets. We're going to double down on niche, senior housing, BTR, light industrial, medical office buildings, suburban offices. That's what we like. That's what we've done in the last 2 years, and we're going to double down on that, despite everything that I told you that doesn't look very promising. One thing that we tell our investors is make sure that you protect your wealth as a strategy and don't just rely on ROI and which investment's going to give you more returns, because when a recession and a depression happen, the market corrects and you want to have your assets and your wealth in assets that maintains itself. So anything, again, gold, silver, and in Texas, commercial estate or land. And then, as always, location, location, location. Do you have the right visibility? Are you on the side, on the right neighborhood? On what street? Facing, the right traffic? Do you have visibility? Do you have access? How hard is it to get to the highway? Are you near Starbucks, um, Chick-fil-A, and Whataburger in Texas? Those are the 3 that I always look at before we do anything. Are you close to the highway? Are you close to the new rooftops that are still happening Northwest Houston is the fastest growing area in the nation. Same thing with Dallas. I think Dallas and Sherman will connect soon. And so, again, being very precise and very selective is the way to go going forward. So, despite maybe the not so positive view of the economy and where things at, we think Texas is the exception, and being conservative and selective is the answer in this tough environment. With that, we'll open it up to questions. I hope this was helpful for everyone, and I would love to go through that with you, Sammy.
Yeah, if anyone's got questions, feel free to put them in the chat. I know Brandon asked a question really early on about the auto market. I don't know if you've got an answer or response or not.
Yeah. Okay. Tariffs are hitting the auto market. So anything that is not made in the US has become a lot more expensive, including German cars and friendly Europeans. Um, China, 100% tariffs. We don't want to see their electric cars in the US. Electric cars are not happening. I bought me an electric vehicle because I knew they were discounted. And GM a couple days ago, they said they wrote off $7 billion on electric cars. So I was right. But overall, more manufacturing when it comes to trucks locally and more tariffs on, I think tariffs is going to continue to hurt the European and the Japanese. A lot of manufacturers I've noticed have moved permanently into the US to have factories here in the Carolinas and in Atlanta, not Atlanta, Georgia. Um, but still, I think in a way the government is subsidizing GM and Ford, if that makes sense. So we're going to see more GM and Ford, more gas, no electric. But I'm answering your question as a consumer, not as an expert.
All right, for asset classes like senior housing, build to rent, and medical, which you mentioned are growing, what do you look for first when evaluating land? You mentioned the deals are super zip
Ah,
code specific. It's really
yeah,
good. Yeah.
yeah, that's a great question, Helen. When it comes to medical office buildings specifically, it needs to be anchored by a hospital or close enough. So that's one criteria. Again, in the growth areas, so we love the suburbs in Houston, Northwest Quadrant, and north of Conroe as well. So when it comes to medical office building, anchored by a hospital and new rooftops. Build to rent communities is we like to place them in great school districts where houses are not affordable. That is a premium land, but we try to stay in the suburbs as much as we can. Montgomery County, um, around Cypress, North Katy, those are established great school districts. And we try to find pieces of land that sort of satisfies that. So schools for build to rent, hospitals for medical, senior housing. We don't like the senior housing communities to be extremely out there. We like established suburbs. So, the Tomball areas, the Cypress areas, Friendswood, if there's enough land left, um, and in the southwest quadrant, kind of away in the Rosenberg area in Houston specifically. Same thing in Oklahoma, north and northwest, and Dallas on the north side. But short answer on senior housing, around not too out there. We want it to be established suburbs around medical and around churches and around services. And so it feels safer and accessible, even if it's isolated from the surroundings.
Al, should I plug a possible upcoming webinar on that topic? We've talked about we usually do a peek behind the curtain webinar each year. And this year we were talking about doing like a finding the right community one. So, Helen, it sounds like that'll kind of get to that question as well. So stay tuned.
Awesome.
All right. So Brandon's also asking, yeah, we'll keep you posted. Should be in a few months, I think. The US is refinancing 8 trillion in 2026. How do you think that affects interest rates?
I would say my prediction is we're going to go into a digital currency. That's my short answer. We can take it offline and talk more. But digital currency isn't the current crypto, it's more centralized crypto. And I think we're gonna do a couple of we're gonna build our, we're gonna try to build and shield some of our infrastructure and build more chip manufacturing, become less dependent on other nations and supply chain. And I think we're gonna then pull the plug. But that's all crystal ball stuff.
Yeah, and it looks like I just got unmuted. I wasn't able to type all that that quickly, but yeah, I think it's interesting to think about with that refinancing side to it, but also within the national strategy that they had released in November,
Mhm.
they are actively uh, pulling away from the East. So pulling away from China, pulling away from the Middle East, and I think this is part of the reason why they did the thing with Venezuela. But they're trying to set up supply chains in South America, and how that's going to sort out in the next 10 to 20 years. I think that'll be really interesting because obviously it's going to trim down on some of the logistics, the costs for that, in terms of how it's, or in terms of the cost of manufacturing and all that. That is, I think that's still to be seen. But yeah, it is definitely going to be a totally different world dynamic. And I'm curious, like, what your thoughts are for
Yeah.
if everything is shifting to the Western
Yeah, I
Hemisphere.
think long term doesn't sound like a bad policy or strategy. I'm worried about the execution. So I was like, okay, yeah, we'll move manufacturing. Well, it doesn't happen overnight. And as you transition, you're going to have higher inflation because if you want to make the Nike shoes back in the US or in Mexico, it's just going to cost more. And, that applies to everything. So I would say long-term strategy makes sense. We're going to have some disruptions along the way. That's why we need to continue to play safer bets, niche, premium rent. Remember the economy stat where the majority of GDP is coming from investors or high income? We want to be in that space until the administration say we're going to subsidize low income housing. If you leave it to us developers, the math doesn't add up right now to do affordable housing. So I think if we don't see subsidies, the tariffs and the inflation will hurt people short term, or even if it's a long term good strategy. So we have to see subsidies. We have to on the lower end and the affordable end. But niche at least can be recession proof for the next couple years for us.
I guess if nobody else is going to ask a question, when do you think the AI bubble is going to pop?
By the way, I'm a technologist, so you can treat me as an expert. I used to do AI in 2014 before it was popular. Real
Wow.
AI, like oil and gas, more out of the field with less resources, top of AI. Um, it's a self-fulfilling prophecy right now. It's like you go talk to any investor. And they'll be like, why should I put my money in real estate? It's boring. Look at my stock growing. Like, so, okay, great. Go for it. And then the deals they cut with the data centers, just scams, in my opinion. Nvidia goes to Intel and they kind of say, okay, we're just going to do a handshake and put it in the camera. And then all of a sudden their valuation is up and that's how they pay for the new factory. So it's funny money. I think the bubble is coming. I think AI is great. We're actually going to talk about AI specifically in March, Brendan. So welcome to join us in March. But basically, I believe in AI. I don't believe in a hype. And uh, everybody is saying that AI is just going to save us. And I'm worried about that. Because as I told you, if we take the high income families from the GDP spending, and the AI investing, the economy is actually shrinking. Nobody talks about that. So AI hype, no. AI adoption and productivity, yes. I
Yeah.
think it's soon. I think it's soon. I don't think probably 6 months. I don't know. That's crystal ball again, but I think it's soon.
I think a lot of people are seeing the circular economics that they're doing,
Yep.
and I think it's there's something fishy.
Look at this chart. It's actually generated by AI. Funny, that I shared earlier. Where was it? This one. This is Moody's AI model. How far are we from the threshold? Not much. Not much. So I think that's speaks to that. Yeah. Again, don't freak out. Just buy more commodities.
Yeah, Esmont asked a really good question. If a recession is imminent, what strategies separate survivors from forced sellers?
Where's my mug? I have a saying, Warren
Your
Buffett.
Buffett bug?
Yeah, my Buffett mug. I have a
I
Buffett
don't have
mug, and
one.
the best one is when everybody gets scared, you need to be greedy. That's the best advice that Warren Buffett shared. Now, greedy, you don't need to be blind, but you just need to double down. That's what he means. So, yeah, when everybody's scared, just get more greedy.
Nice. We've got one more question in the chat about the northwest area of Houston, if that's also good for residential investment.
Yes, but not single family right now. So if you're buying that house to rent it, I wouldn't do that necessarily as a single family landlord or owner. Um, you may still be better off doing something in inside the city for Airbnb, for example. We have a project in Midtown where we're doing nicer units for Airbnb. Residential investments as an individual, it's kind of dangerous right now. We do things at scale, meaning we go build a 120 unit community, for example. And so if that's your question, yes, we double down on BTR, build to rent, and senior housing. That's the two that we're focused on. Home builders are not doing great right now. If you want to grab something severely discounted, they're cutting down the rates. They're buying the interest down. They're the I've seen houses discounted 50 to 100K from what they're listed the price at. So if you're doing it as an individual investment, just be careful around the possibility that you can't rent a full house and get stuck with the mortgage. I would focus more on Airbnb if you're doing, one or two units here and there. And I think Northwest is not great for that. You need to be closer inside the city. But for senior housing, build to rent, duplexes, quads, Northwest would be great.
Ooh, I like this question too. Any go-to podcasts you'd recommend for market outlook and
Make
CRE?
sure you don't follow gurus.
Good
Um,
data-driven
Marcus
people.
and Millichap, definitely amazing. But my top one, Marcus and Millichap, they do these nice weekly short videos. They do monthly webinars. Bigger pockets, I think they're coming back to their senses. At one point they were great. Then they I guess tried to justify themselves or their existence, and I think they're coming back. So they used to just it's a one trick pony where they're like, oh, you just need to fix and flip, and they want to make everybody in the world fix and flip. I think now they're talking more realistic. So I would say, yeah, Marcus and Millichap is the best one when it comes to real estate. We'll be happy to share some more resources when we send the recording as well, Sammy. Let's include some of the links. And
Oh, for
then
sure.
the slides, when I shared that earlier as well, there's a lot of great resources. ITR is my favorite economy reports and prediction, ITR Economics, Marcus and Millichap. BizNow is the best news source. So if you want to like listen to what's happening, BizNow have local chapters and they're very good. They're very good. They throw events. So between Marcus and Millichap, BizNow, and ITR, I think you got a good list of things to follow. All right, let's see. Can you elaborate on cryptocurrency and its use in real estate? There's two answers here. I think crypto right now is gonna suffer a little bit. If you invested in crypto, this is the time to exit, in my opinion. And then the relationship to real estate. So the way we do real estate is we work on with SEC attorneys to divide a commercial real estate property into shares. And we created like a 150-page legal document that our investors sign to become limited partners in our deals, and then they fund the money. Where I see crypto merging into real estate is actually Portugal out of Europe. They started to see digital contracts, started to see secondary market for shares in real estate. If you follow Fundrise and Yield Street and all of these platforms, they still old school. You still have to DocuSign something and send the funds manually. I think the future is more digital contracts than crypto itself. That you can exchange your shares in a secondary market, you can do everything digital, and that will merge that yeah, you can buy your shares or buy your shares with crypto, basically. But I think the transition will be digital contracts first, blockchain, and then crypto connection to blockchain. I think that was the sort of prediction globally that we're going to see digital contracts first, but because everything is going national, blockchain is kind of put in the back burner. So I think cryptocurrency becoming the currency is going to move faster than blockchain. Because as Brandon talked about, is we're no longer going to be getting our supply chain from all of these distributed nations. It's going to be more localized and nationalized and, with our neighbors too. Um, I don't see it happening anytime soon. I think we're still going to be old school for a while. And we might see our currency converted into crypto before we see digital contracts in any meaningful way.
Mm, yeah, I like Esmat's follow-up question before you get to the other question. Do you think people will trust executing contracts digitally soon? I mean, you kind of answered that already.
If you don't understand blockchain, do not approach. Do not approach. No, I don't think it's going to be. Yes, we have all kinds of hackers into all of our title companies to get people's information and bank account and social security. Is that safe? It's not safe. I would trust digital contracts personally more than a title company. Data security, let's say. But no, I don't think digital contracts will happen soon. I think crypto will be more faster than digital contracts. But I do see us well set up for that as Investream because we already break our big properties into shares. So it's just a technology adoption whenever this happens. We don't want to be pioneers in anything.
So
What
what?
signals
Yeah.
should investors watch to know when the market is truly turning? Price correction, interest rate, gas going even further down, interest rates start dropping, and layoffs. Layoffs. You'll hear about it. Layoffs typically is one sign from a corporate point of view, interest rate from a real estate point of view, and then we may see gas at 180, 185 soon too. Foreclosures in real estate too is a sign when you start seeing foreclosures, right? I know we're going over, but great questions. Keep them coming. If you have any final comment or questions, please plug it in before we wrap this call up. Appreciate everyone.
Otherwise, I know you opened by saying you wanted to talk about hope. Do you want to
Oh yeah, I already
end
told you
on
we're
any?
doubling down. That's my hope. Like I tell
There you
I
go.
tell my team every week that watch for these things, watch for these things. But we're going in. We're doubling down on Houston, Dallas, Oklahoma City, all these niche developments. We are in a land hunt right now, generally speaking. We're in a land hunt. We look at land on a daily basis.
Helen, it's funny you say that because we're starting an internal book club. Maybe we should externalize some
Oh
of
wow. Yeah, we talked
it.
about book clubs a lot in the last couple of weeks.
Yeah, yeah, we've been very book club heavy. I guess it's rubbing off. Ooh, all right. If you had 10K or 50K in a savings account, what are good areas to consider putting it? Commodities like gold and silver, real estate, or small businesses? Is this a question or is this a question and answer?
Um, yeah, don't keep your money in liquid form. Be careful of stocks. That's a short answer. Always diversify. Don't put all your eggs in one basket. Don't dream. Don't hope too much. Like this is not the time to dream. Don't be wishful. Just diversify between commodities and stocks. Be, aware of what's happening on the AI side. Maybe start exiting some of the AI stocks. Pay the capital gain. Don't make that a hurdle. I've heard so many investors say, "Hey, I don't want to sell. I tripled my money." I'm like, I think you should pay the taxes. Don't worry about it. And if you buy real estate, you can offset some of the capital gain too. But this is not the time to start thinking about taxes and other things. You really need to diversify and allocate properly.
Ooh, I haven't heard of these.
Mhm.
Confessions of an Economic Hitman and the Creature from Jekyll Island. Nice.
Yeah.
Should
I
check
mean,
those out.
if you ask me for a book club, read for Ray Dalio. It's my favorite.
We're gonna have shelfies sometime this month. We're gonna show off our shelfies. What day is that? I don't remember. Our
Yeah, I feel like
bookshelves.
Ray Dalio is taking over from Warren Buffett. Warren Buffett, we're done. He's taking a break, but Ray Dalio is the next Warren Buffett. So yeah, he has a lot of great books on the investment side, but he also gets give a lot of great advice when it comes to the shifting kind of world order and supply chain and inflation, etc. So he's both globalist in a good way, and an investor as well. I appreciate everybody's active participation. This has been great. Typically, it's dry and gloomy, but we love those because we like our investors to be informed and chat with us about what's on their mind, what they're seeing, what they want to do, and we always adjust. I would say our strategy is kind of more or less the same, but our tactics are adjusting sometimes on a quarterly basis. So appreciate everyone. This will be shared after the webinar and posted on our YouTube. And look forward to seeing you in our February webinar. Have a great night. Thanks.
Perfect. Thanks, everybody.